we're seeing a lot of even, quite young founders running this playbook, achieving levels of wealth, even in very basic businesses, HVAC, plumbing, electrical, for example, even just the core trades that quite frankly are astounding. We're seeing founders who get called for that. And so we see a lot of them using private debt, which by the way is like 10% cost of money instead of 30. And they're the private equity firm. They're the equity. They're putting all the dollars in their pocket that the private equity firms used to put in their pocket into their own pocket. He had some health issues and had 2 daughters, wanted to take care of them, but really he wanted to take care of his family, but he also wanted to get up and charge his mission every day. We allowed him to keep his company, give up zero dilution or zero control, took $60 million off the table, sent it to his financial advisor, so it's totally liquid, got to keep his company and continue the mission. The bank told me we could have 7. Now I can get up and do what I want. There was no personal guarantees, so when they find out they don't have to give up control and equity to do that, they're pretty excited. When that goes right, it's pretty astounding.
Hello, everyone. Welcome to another episode of This Is M&A. My next guest is the co-founder and president and CEO of Bridgepoint Investment, where he's helped build one of the fastest independent investment banks in the country. Over 19 years in the industry, including time in private equity fund management, executed more than $41 billion in transactions, about $17 billion in M&A, $23 billion in capital raising. After earlier career stops at Morgan Stanley and Deutsche. He's also the co-founder of the YPO Investment Banking Forum, a thought leadership group bringing together young founders and investment banks. Under his leadership, Bridgepoint has been named 3-time Inc. Best Workplaces and appeared twice on the Inc. 5000 list. They're also recognized as the first impact investment bank championing purpose-driven deals alongside profitable growth. Matt is also recognized with several leadership awards, including Emerging M&A Leader, the Global M&A Leadership Award, and being named Midland's 40 Under 40 winner. In his spare time, he's an avid fly fisherman. He loves spending time on the water whenever he can. With that, everyone, please meet my guest, Matt Plooster.
Hey, thanks, Steve. Super excited to be with you today and chat with you again, and excited for the conversation.
Definitely happy to have you. I enjoyed our previous conversations. In fact, you being a fly fisherman, I happened to be in Alaska when we first connected. So we were able to exchange some fishing stories. I look forward to kind of picking that back up at some point.
Well, and 2 good fishermen, not only stories, but photos, right?
Exactly. Yeah, 100%. But happy to have you, happy to get this episode going. Today, we're going to be diving into something that every founder wrestles with at some point, right? It's the founder's dilemma, deciding between growth, capital, recap, or full exit. So what we're going to do today in this episode is we're going to ultimately unpack growth capital without losing control. So when raising capital fuels expansion versus when it's just a distraction, and the trade-offs, between speed, dilution, and founder control. We're also going to talk about liquidity on your teams, right? How recapitalizations and other structures can actually help founders achieve liquidity without giving up the driver's seat. And then lastly, but not in this order, we're going to touch on the exit equation, right? What it looks like to run the private equity playbook, but actually not have private equity, and how to know when it's time to sell versus to continue building. So with all that being said, Matt, we have a ton to unpack here. There's a ton to uncover. So I just want to jump right in. Where should we dive in at this point?
I think let's talk about raising capital as a founder and, the growth capital dynamic, managing capital raises and, potentially doing so for founders without losing control. That would be a super neat place to start.
That works perfect. So, but do you have a particular direction you want to go?
Just to start, and then you can kind of lead me. Does that work for you?
Perfect.
And this is a really fun and cool conversation for a couple of reasons. One, I'm an investment banker, right? So capital raising is one of the 2 things that we do all day, every day, but I'm also a founder myself. And so while we're raising money and helping companies think through, growing their companies and raising money, I'm also doing that myself as somebody that is building a business, a capitalizing business. That's reason one. Second reason is it's an exciting conversation because the options and solutions available to founders and CEOs and business builders today are better and more thorough than they've ever been, especially down market for what I would call Main Street American companies, founders, and families. And at the same time, most people at this end of the market don't know about it. So one thing, I'm passionate about it. I'm experiencing it and going through it myself. And two, there are a lot of solutions, and most people don't know about them. So excited to talk about them here today, Steve.
Yeah, no, I'm in a very similar boat to you. So I'm looking forward to jamming out on this conversation with you. So maybe what we could jump into is, what's the difference between fueling growth and just, I guess, buying runway, right? How can founders tell, I guess, which camp they're in? Let's start there.
Yeah, I think it's interesting, and capital is fuel. I can think of a software company owner of mine. He's like, I just need more fuel, and the bank will never give me enough fuel, right? And I think that, and I'm sure we've all gone through this in our entrepreneurial journey, right? Of what is the right growth rate, right? And at the same time, I've seen, so backing up, when I founded the firm, we were actually a merchant bank, and we had a venture fund, and we actually provided early stage capital as well. And a lot of our companies that we invested in, like the CEOs would go from business builders, right? People that had an idea and a dream and led teams, to the venture side, particularly in the earlier stage side, is so difficult that the leaders almost became full-time capital raise people, right? And we're spending more time at coffee shops with venture funds or friends and family than they were actually building their business and their product or their solution. And so definitely, that is the catch-22 as a leader, right? Are you a fund manager and a fund placement person, or are you a CEO and a visionary and a leader? And so that definitely is a trap that I have seen founders and owners fall into. At the same time, capital is also fuel and its competitive advantage, right? And so if you have it, you can do things that your competitors can't, and you can move quicker. I think the traditionally in Main Street America, it's like there are banks, there are friends and family, and then someday I'm going to sell the firm. That's kind of, or the company, right? And that's kind of the solution set. It's like I've got friendly money or super low cost 5% money, and someday I'm going to push the red button and I'm going to give up control. And those people, the cost of capital is like 30%, and that's it. And so growth was traditionally very limited by how much capital you could get, which was never really as much as you, as a founder, generally wanted, right? Fast forward to today, the capital efficiency that's existed for very, very large public company and private equity owned companies has come down market. And so the capital markets and capital availability is more efficient. And institutional capital, non-bank capital, but funds who make debt investments, equity investments, and everything in between have come down market and are pricing capital. And I think that's helped the dynamic for those that are in the know and that have capital connectivity, or have a good advisor or board that has capital connectivity, to find capital that is more consolidated, with one capital provider, where they've committed capital partners and where they don't spend all of their time in coffee shops trying to raise money or doing the bank tour, talking to banks about how they wish they would give them more money. And so the efficiency and the amount of capital has come down market, and there are now a lot of funds that are dedicated to what I would call in-between capital, or non-bank credit, structured equity, structured capital, down market for Main Street American companies. And so I would, while that has been, capital could be a distraction, the capital raise process could be a distraction historically, I think with the right group of advisors and the right capital connectivity down market, it actually probably has become more borrower or capital friendly. And there are a bunch of solutions to where companies can go out and find one provider who wants to give them more money, not less, and doesn't want to just get it back from them. So it's an exciting time to be having this conversation, but no bones about it. It is an issue for a founder. Which hat am I wearing? Am I wearing the operational hat, or am I wearing my, capital partner, go sell hat? So
It's a full-time job. I've been in that position and am in that position, and it literally is a full-time job, and it helps to have some solid advisors that are helping guide you along the way, or helping just hold you accountable so that you're putting the time against it. Because it is so easy as an operator to get so focused on the operations that gets pushed to the wayside, right? There's always something going on in a business that requires an operator's attention.
yep. And both of those are full-time plus jobs, right? So there's always opportunity costs. So I think we get a good topic there on just trusted advice. And if people are telling you that you can't have a capital conversation, I would, your current advisors, I would kindly say you should find new advisors, because the conversation is out there to be had. It is still down market, though. There are a select few that are pretty familiar. So it's an exciting conversation.
Definitely. And I always tout the importance of just having a solid team behind you. And it's not just your executive team, it's the team that you bring in to help you with whatever process you're trying to run, whether it's M&A, whether it's a fundraise and so forth. You want to have solid advisors for sure. So, I guess when it comes to raising capital and when it comes to, companies that are high growth and whatnot and feeling growth, have you seen kind of a shift in the market? Because I know I've seen kind of this shift where it's no longer growth at all cost. There's a lot more focus on EBITDA, right? And break even and EBITDA positive. Have you seen that in operational excellence? Have you seen that shift over the last couple years?
Yeah, absolutely. I mean, I think, coming out of COVID, 21 was gangbusters, right? In the capital market, seemed like there was a unicorn every day, right? With somebody with an idea, and it was kind of growth at all costs. I think things on Main Street in the capital markets have become more rational, which happens, right? The pendulum swings. It feels like we're back more to a normal of focused on good growth and building sustainability within companies, and not just having growth, but actually, at least breaking even or being sustainable entities. That's certainly the case. And it absolutely ties to what your capital options are, particularly on the credit side, on the non-bank side. And so that definitely is where the market is at. In our M&A business, Steve, we kind of chuckle, and we've kind of coined it a flight to boring. Like, investors want boring. They want predictable. They want like a GDP growth business that makes money, through cycles, and that isn't super volatile, is really sexy in this market. And we're actually having better outcomes for those companies than we are the super high growth companies where people are like, I don't know, is the growth rate 10%? Is it 200%? What's it going to be next year? And oh, by the way, we're earning cash. So the capital markets landscape definitely has a preference for predictability and cash flow at the moment.
Makes sense. Yeah. Yeah. And resilient businesses, right? The ones that if you've been around for 10 years, you've been through some challenges, right? With the pandemic, with what's going on in the economy, right? All of those things.
Yeah. And I think the check writers, right? The funds across the landscape too. I mean, there's how many global, issues are out there that could be something else, right? And so those companies where they feel confident that they know what it's going to be at 12, 24, 36 months are way more exciting to them to achieve their return hurdles than, it might be a grand slam and it might be a zero.
And earlier you kind of touched on the growth and what the expectations should be. And those expectations shift depending on the industry, depending on the business, depending on, are you bootstrapped? Are you feeling growth through equity raises, through, right, raising rounds and so forth, right? How does a CEO think about that? How would you recommend to go down that path to figure out what should my growth numbers be? We're a bootstrapped company ourselves. I'm not chasing 40, 50% growth, right? It also matters how competitive your market is and all these other things. On the other side, I'm also not burning a bunch of cash. We're interested in being operationally efficient, free cash flow to fuel our business. So we're more focused on EBITDA, right? Making sure we can free up some cash to spend and put it back into the business. Any tips or tricks around that you can give to a founder or CEO on how they should be thinking about what their growth numbers should be?
I think that it's pretty basic in that I don't see many businesses that actually intellectually, honestly evaluate what growth rates versus capital availability look like. I kind of see a bifurcation of reactive founders and management teams, right? You just kind of shoot what's in front of them. And whether that means, steady state or 200% growth, it's kind of just totally reactive. And then I see the growth at all cost founders and CEOs. And the reality is capital can be used probably to achieve different levels of growth. And, having a rational conversation at the board and at the C-suite level of, okay, if we take on, X dollars, it allows us to do these things. We look like this, right? Here's what it comes with: governance, control, dilution, all that stuff. That seems really basic. Like that's the planning conversation that a Fortune 500, fiduciary board of directors has and makes decisions around. I think slowing down at the board level or the ownership level to actually be thoughtful about capital versus growth is really the magic, is actually doing the work versus just running at, all or nothing or being reactive. And finding good advice around capital availability and the terms of that capital and what it allows you to do from a growth standpoint, really, I think allows a founder or an owner to achieve the right objective, which, by the way, might be different for different folks, right? You might say, hey, I'm building this to sell. I want to maximize my sale price and my enterprise value, in 5 years, and that's my horizon. Or you might be like me, like I hope our business is a multi-generational business, right? So I'm risk weighting kind of growth. I'm a growth guy, right? Just like you, we're mid-40s, we're young. Growth fires me up, but I also don't want to grow too quickly as to where we lose the important things about, core values, culture, legacy, and mission. And so I think it's different answers for different founders and CEOs based on their priorities, but actually slowing down and having, doing the work around capital versus growth is something I actually see very few people do. And I think a lot of it is most of them don't have the advisors that actually, or the relationships to actually help them evaluate that, right? The phone rings, some guy with some type of capital or gal says, hey, I can do this. And it's like, oh, should I do that or not? Versus here's what the entire capital landscape looks like. We could go do a private debt round, right? We could do a unitranche deal. We could do a mezz deal. We could do a structured credit, structured equity deal, or we could just go out and do a straight equity deal. How much of that capital could we get? What does each types of those capital providers provide? What does it mean for us on all the, control governance terms thing? That's the exciting exercise that I think allows a founder or a founding group or a management team to get to where they want to get in the best way possible.
Makes a ton of sense. So is there a formula that you use, or maybe just you, and when I say you with your clients, or even just you as, in your own business, as you mentioned, you're growing something as well, where you decided we could either fund this growth internally, or we're going to take on some dilution? Is there like a formula for how founders and CEOs should be thinking about that you've kind of come up with?
I mean, the math is pretty easy, right? Like everybody can do equity math and say, I've got 0% dilution, or I've got 49% dilution, or 51% dilution. That's really just economic math, to be honest. And the voting implications are always that meaningful. I think what it really is, though, is a control issue. And for all of us that own businesses, control is a huge thing, right? And so I think that's the conversation we generally have between, debt capital and equity capital is mostly around control, even more so than it is around the economics. I think the thing that we've seen that's probably the most exciting to me is, 21 or 22 years in the capital markets as a banker and a capital provider, is the proliferation and for the first time in history, access to Main Street American companies of non-dilutive capital. And so particularly over the last 10 years, there's a lot of non-bank capital out there that will do debt or debt-like issuance with way more capital provided to a company than a bank at a higher cost, but at nowhere near the cost of common equity, let alone the control and the governance. And that's a really exciting thing. So,
yeah, and there's some benefits to it, right? You pointed out not losing control, but also, the debt equity could be used for several things, right? It could be used just to extend your runway, so you could go raise real equity, so it doesn't look like you're dying on the vine. It depends on what stage you are as a company, right?
The pros of that capital, if it's helpful, Steve, I mean, more capital than a bank, not as much as equity, but certainly more. Capital providers that actually have a mindset of wanting to provide you more. I mean, traditionally banks are like, here's $10 and how quickly can I get the $10 back? The non-bank funds are more like, here's $10 and how do I give you another $10? Because that is my business. Generally on a non-personally guaranteed and non-recourse basis. So those of us that are founders, they can't come take our house. Generally for things that banks hate, understandably, because of their cost of capital. I mean, banks are a very important part of the ecosystem, but non-bank credit, for software companies, right, with no collateral, growth collateral, dividends, acquisition finance, things that generally a banker would say, that doesn't really fit my 5 to 7% return, cost of capital. Also, full control, so not giving up control. Have the mindset of being a capital partner that will provide you more. The cons of that capital are, whereas bank capital is like at 6 to 8%, this is probably 10 to 12% money. The dirty old secret about equity, though, which everybody I think views as cheap because you don't have to pay current interest, is the return that you're giving up as a founder. And we'll talk about this in a while with running the private equity playbook without the private equity. Equity folks are generally underwriting cost of capital of 20 to 30%. So while it's not current pay on interest, that's really your cost as a founder. You're giving up a huge return on capital. But you do have one capital provider who's committed to providing you growth capital as you grow and wants to give you more, and generally for things that banks don't like. So it's pretty powerful, and it can be used in tandem with equity. But it creates real efficiency to achieve, like you said, levels of growth and levels of uses of capital versus just a kind of an all or nothing, right? Like
Correct. And the speed in which a bank operates versus these folks, the cash is coming to your bank account a lot quicker.
Yeah, and they might say, Steve, you want to go buy, you've got a roll-up play, right? You want to buy 15 competitors. Like, we're going to pre-wire it day one, and we're really your ATM machine to go do that. Instead of doing a one-off bank deal every time or doing a one equity round, your capital partner is like, all right, as long as it looks like this, here's the wire.
Yeah, and there's all kinds of ways I've seen they've structured it. It could be revenue-based. It could be term-related. I mean, there's so many ways you can structure it to make sense for your business. Let's shift gears for a second. Let's pivot over now to, we were talking about, one of the topics is liquidity on your terms, where, I surfaced, recap. Let's start in plain English. Like, what is recap and how is it different from a traditional growth round?
Yeah. Recaps can mean a lot of things. Recap, really, the term means redoing your capital structure, your debt equity mix. The exciting part of, and so that can be, how risky do we want to be, right? How levered do we want to be versus equitized? That's kind of traditional finance. I don't, quite frankly, find that exciting. It's kind of financial engineering. What is exciting, however, is really about 10 years ago, this started to happen. We built Bridgepoint as one of the leading private credit practices for founders and families in the country. And we really built that practice about 10 years ago when people started to do it in the capital markets around, can you have your cake and eat it too? In other words, Steve, you probably look a lot like me, which is we're business builders. We've poured every cent that we've ever had into it, right? We've signed all the personal guarantees. And at some point, your company becomes successful and you've got a PFS that says a big number, but it's really this illiquid thing, right? That's it's a company, right? You have zero liquidity or near zero. And so we started doing dividend recaps, which private equity firms that, fancy finance folks have used for a long time, but we started to use for founders. And the first example, maybe I'll give you a case study because I think, a real fact, a real set of circumstances probably means more than an investment banker.
Oh yeah. Yeah. Definitely.
A guy came to us, he's since passed away, had some health issues, but had built a nice business, was doing like $15 to $20 million in EBITDA or cash flow, was a very mission-driven person who had built a business. Like, that was his life. Like, he did it. He believed in the mission. He was really dedicated to rural America, and he had some health issues and had 2 daughters, wanted to take care of them, but really wanted to just, he wanted to take care of his family, but he also wanted to get up and charge at the mission every day. And he had an offer to sell his company for like $200 million, didn't want to do it from a big family in America. Everybody would know their name, but was kind of like, well, if I don't, I went to Wells Fargo and they said I could have $7 million, so it's like, do I not give my kids $200 million? Where is that? And we actually had sourced a dividend recap where we allowed him to keep his company, give up zero dilution or zero control. He actually bought back some minority shareholders and went from like 89% to 100% ownership, took $60 million off the table, sent it to his financial advisor. So it was totally liquid, and took debt on the company to actually make it liquid and, got to keep his company and continue the mission. And that was like, oh my gosh, the bank told me we could have 7, which is a lot, but not enough for multi-generational family wealth. And I got to spend 60, and, now I can get up and do what I want. And by the way, that was on a non-recourse basis to where there was no personal guarantees. So, get hit by a bus and, the family's good. That's a really exciting conversation. I had a conversation last week with friends that own a $1 billion business, and they've got no debt. They've got great cash flow, but it's like, Armageddon happens and this $1 billion business could be zero overnight. Do I take $100 or $200 million off the table, send it to, 100 to a financial advisor and another 100 in some diversified investments, and then it's like, I feel pretty good, right? I haven't taken on much risk, but I'm more diverse and I'm more liquid. Giving owners tools to keep their company, which is exciting, and keep growing their mission while also not having to be all in on a personal basis is really probably the most exciting facet of that. The reality is we use non-bank capital to do that. And most deals have some dividend, some growth capital, some shareholder buyout, right? There's a host of things that you could use the capital for when there is more capital available and you don't have to give up control or equity. That most company owners probably have a list of those things. They've just had the list over here because there's never been capital to fund it. So it's like in conversation.
That's an interesting case study that you gave. What's the right time to to start to explore founder liquidity? Is it when things are growing fast, or is it when momentum starts to slow? What have you seen out there? Is there not necessarily a right time?
One, when's the best time to plant a tree? Yesterday, right? But that really relates not to necessarily doing a deal, but being aware of what your options are. So the options in the education, I think, is always yesterday. I think when is it the right time to take chips off the table is mostly a personal financial decision more than a corporate financial decision. The math on how much of that you can do is pretty basic. It's always a multiple of either EBITDA or recurrence. Given that it's non-dilutive, it's a little less critical on timing than equity, right? Whereas if you're a rapidly growing company, if you dilute today, it might be way more expensive than in 12 months, right? When your valuation might be way higher. So I think that's mostly a personal decision. I think the neat thing that we've seen with our clients, including some people who are now just dear friends because we were their partners as they grew and eventually monetized their business, is having liquidity as a founder is really a mindset shift that most founders never have the luxury of, right? It's like, I'm going to, blood, sweat, and tears at some day I'm going to push the red button. And I was all in 120% from a risk and sleeplessness standpoint until that happened. We've had a couple of case studies where it's like we did one of these dividends and the founder, got, I don't know, 10 to 100 or $200 million. And then when the phone rings and somebody wants to buy you, it's kind of like, well, now I really don't have to do anything.
Yeah, you're in a good spot.
Very empowering as to making the right decision at the right time versus, owning and running a business. We all have good days and bad days, right? And we see a lot of M&A deals and sales being done when, my number 3 person quit. I'm distressed and the phone rang and it was a private equity firm and, screw it. I'm going to do the deal because I'm worn out.
Puts them in the control seat and also probably gives them that second burst of wind, right? We've been grinding for so many years, and it gives them kind of like that light at the end of the tunnel. It's like, all right, I'm cashing out, I got some cash out on this. Let's keep going, right? It probably rejuices them, I guess you would say, right?
It's for your money instead of my family's money to do so. Yeah.
Exactly. So in that recap process, how do you make sure that doesn't send the wrong signal? Because it could, I guess, employees or the market could look at it as a wrong signal potentially, or a wrong message. Any advice or anything that you can give to the listeners on that front?
It's a great question because most of our clients, private companies, the most distressing part is actually communicating, to employees and partners that have been so loyal. That's been a huge part of the success story. And I think it's a great question, Steve, because I actually see our clients and even like my, YPO forum mates and, business builder buddies really stress that a lot. It's the most stressful part, actually. Even deals are hard just because of the emotional, the relationships. The reality is it's a really positive message. And the message usually goes something like this, which is like, look, we could sell the business. We get calls every day, which everybody today gets calls every day because there's now more private equity funds than there are McDonald's. That was the meme 2 weeks ago. I don't know if you saw that in America.
I didn't, but there is that. Yeah,
it's actually a fact. But I chose not to do that, or we chose not to do that. We chose to take a minimal amount of chips off the table because we've been all in an effort to actually maintain continuity and not sell, and also find a growth partner so that you and we together could continue to grow this business, and you and we could continue to have more opportunity as employees and as owners competitively. So usually it's more of a growth capital conversation, which most employees and partners are actually fired up about.
Right. They'll welcome that.
And and I think what you usually find too is most employees actually assume that every owner is getting called, and it's probably a relief where they didn't, and they just chose some other path to allow the mission to continue with the current ownership group. So generally very positively, and it actually strengthens the company from a financial standpoint too, for continuity for employees.
Yeah, and it's the message you just delivered is probably even more impactful in the type of customers that you're servicing, right? Where these are founders that have real strong missions, right? So, being able to carry that forward and continue that forward, but still getting some liquidity at the same time, and rejuicing them, re-energizing them, and having the growth capital now. It's powerful. It's a powerful message to deliver to the squad.
Exactly. Yeah, absolutely. Great question though.
Yep. Thank you. So let's let's tie up on that. Unless you have any more comments on that topic in specific, let's tie up on that and let's shift again to the exit equation. Right. We're talking about running the private equity playbook, but not actually going the private equity route. What does that mean? Some folks may not even know what that means. Period. Right. So let's start there.
Yeah, no, and I think most probably don't. But I think most will understand the dynamic. And this is actually a really exciting thing for founders. And we're seeing a lot of even, quite young founders running this playbook and achieving levels of wealth, even in very basic businesses, HVAC, plumbing, electrical, for example, even just the core trades that quite frankly are astounding. And so really what we mean by running the private equity playbook without private equity for a company or an ownership group is traditionally, if you're listening and you owned a company, you're getting calls from private equity firms, right? And you're either the platform, which means you're big enough and you're sophisticated enough as a management team that they're going to buy you, right? But then they're going to roll in smaller mom and pop competitors or, strategic assets underneath and run that playbook to grow and create a lot of equity value or enterprise value and real private equity math, right? Hundreds of millions of dollars using a roll-up strategy. What we're seeing, and this ties back to non-bank credit and non-bank debt, we're seeing founders who get called for that saying, wait a minute, that cost of capital from the private equity firm, it's really costing me, probably 30% as a cost of capital. And oh, by the way, I'm really kind of the magic, right? There's so many private equity firms. Capital is a little bit of a commodity. What isn't a commodity is great operators who have the ability to roll those assets in and go buy acquirers, et cetera. And so we see a lot of them using private debt, which by the way is like 10% cost of money instead of 30. And they're the private equity firm. They're the equity and using their existing operations, levering them to buy competitors. And if you do the math on what 10% cost of capital is, which by the way, then you're in control, somebody's not telling you how to run your company, versus 30, I mean, we're seeing multiple, 30 and 40-year-olds across industries, including some very basic ones, create enterprises that are worth hundreds of millions of dollars by using non-bank debt to do that. Whereas traditionally it's been all equity in that in-between capital hasn't existed. So founders have had to take on really expensive equity where really they're giving up most of the return. They're putting all the dollars in their pocket that the private equity firms used to put in their pocket into their own pocket. And now they are a private equity firm. And wow, the success stories, even the Journal over the summer ran an article about how the core trades, HVAC, plumbing, et cetera, were the rich people and the lawyers and the doctors are, now the poor people kind of thing. In these industries where they're very fragmented, there are tons of success stories where very, what I would call mainstream American people are making hundreds of billions of dollars using this non-bank capital to roll up industries. It's pretty exciting. And usually when we're having that conversation, like, hey, this is an option, which by the way, a lot of times it comes to us when a bank is like, look, you bought 15 things and now you're too aggressive or we're out of money or you're beyond our lending limits.
Right.
And they find out they don't have to give up control and equity to do that. They're pretty excited. And when you look at the math, when that goes right, it's pretty astounding as to the wealth creation for the business owner instead of the private equity.
Right. It's, talking about some of those service industries. I got a bunch of friends that own businesses in HVAC and all these others. And you're spot on. They're doing really well. And those are the during this time, those were the M&A transactions that were still happening. From the data room side, we're seeing a lot more of the service industries, the architecture, right, type businesses that are still doing really well. So, yeah, exactly. So, yes. So when it comes to some of the metrics, I guess founders, CEOs, entrepreneurs should be looking at that are signal that it might be time where you're going to get that peak multiple, that it is time to sell. Any advice you can give on that point? Anything in specific? I know timing is so important, right? You don't want to be too late to market to go sell. In fact, I was in another podcast, and one of the bankers was saying, listen, you don't want to be the last to sell. You want to be the first or the second if you're in a new market, right? Was a point that he was trying to express. So is there anything like that you could share with the audience where, listen, this is when you're going to get your peak multiple. This is the metrics you want to pay attention to.
I think two-part answer, and I'll be a little contrarian on the second part. But the first part is there are absolutely those dynamics, right? So like, the joke is in private equity, if you didn't have a DSO, which is like a multi-site dental office, and you didn't have an HVAC roll-up, you're not a private equity firm because everybody has one because the math I just described works. And some of those now are in late innings where like, the multiples were better 2 or 3 years ago. So there certainly are those sector and subsector specific examples. I think it's really hard as a founder and as a CEO to time that market perfectly. And you can get a little bit too cute, if you will. I mean, the market is so efficient. Again, back to my more private equity firms than McDonald's in America. The market is so efficient that if you have EBITDA and you have defensibility and predictability, the math isn't going to change that much. I mean, you might get a spike bid from 15 times to, from 13 times to 15 times. I would challenge that though and say that's fine. But if at the same time you're going to grow your EBITDA from 10 to 15, who cares about the 2 terms, right? So I personally find M&A to be much more event driven and personal journey, longevity and generational transfer driven. I think that's probably the right way to think about it. And I will say that the most impactful people that I see have actually built, and this will sound weird coming from an M&A and capital raise banker who gets paid to do deals, but there are a few instances where it's like, boy, I wish we would have taken. We had one last year where a guy had a bid for $150 million. He's in a very cyclical industry, and now it's maybe worth 50. I'd say that's the outlier. I'd say more like rockstar outcomes. We thought, like, can you believe somebody's paying $100 million for this business 3 years ago? The reason that the smartest finance people in the world are paying $100 million for it is it's going to be worth, on average, 2.5 times that in 5 years. So I would, for the people that have the fortitude to continue to build businesses, there is still no better investment than investing in yourself and your own company. Like, even though you might get liquid, your highest return on equity and most controllable return is going to be in your own company. So I think it has a lot more to do with, company specific or very sector specific dynamics, and even more so where you're at as a leader, where you're at as a capital stack of the ownership group.
Makes sense. I got 2 questions to tie out on this topic, and they're kind of going in not a completely different direction, but they're directionally correct. But they're kind of out of the blue, I guess you would say. One, which is multipliers. We talk about the playbook for PE versus strategic. How does the multiplier shift just in that equation? And then when you find founders who treat their business like PE and run the PE playbook, how does that typically change the multipliers?
Great question. 2 parts. The first thing is absolutely sector dependent, right? So construction companies are worth probably 3 to 4 times EBITDA on average, right? Manufacturing companies, 6 to 12, depending on the dynamics at scale. Software companies trade on a multiple of recurring revenue, which is would imply crazy EBITDA multiples. And there are a bunch of, down the middle businesses now that trade in the teens, which is crazy. Back, 40 years ago, before private equity started, everything kind of was 4 to 6 times, but now there's much more disparity because investors have gotten very smart on all it is really cash flow math. And that sounds basic, but private equity is really math. And so for those industries that can generate growth at cash flow and return of capital or IRR, that's where you see the multiples. And so that's the model for a private equity firm or a buyer, which by the way is the same math, right? Which is what is my IRR in this investment, is not that complicated. The multiples on the private equity without running the private equity playbook without private equity, that's what I think is pretty exciting, right? There are a lot of those industries where the platform, right, the guy that says, okay, I'm going to be the private equity firm, I'm going to go leverage myself to get financial capacity to buy all these things and grow my EBITDA more rapidly through acquisition. That's where, by themselves, they might be worth 6 to 8 times. And as soon as they're the platform, they're 10 to 20 times. And they're buying things at 3 to 5, 3 to 7 times, and they get instant arbitrage. That's where you see people with very basic businesses transforming their multiple based on scale and based on being the platform. And so, like, literally, I grew up in the auto and heavy truck aftermarket 20 years ago, and some of those big guys were worth 12 times, and they bought things all day at 3 or 4 times, right? So as soon as they bought $1 of EBITDA for $3, it was worth $12 for that. I made $9 overnight. The market's more efficient, so that's closed, but I think there's still a bunch of industries where moms and pops are worth 6, and the acquirers, the dollar of cash flow is worth 2 to 3 times that day one on the platform's books.
Makes a lot of sense. So the other part to that question that I was going to ask is, you brought this up earlier. A lot of us are getting solicited with these, offers from PE firms, or unsolicited offers and whatnot. What's the biggest mistake that you've seen founders make when they start getting these unsolicited offers?
The biggest mistake is absolutely, let's just cut through the chaos, right, and the noise.
Yeah.
Reason that by the way, if you're not getting calls, you're not a real company. It's kind of, we don't represent people that don't get calls.
We've made it.
Exactly. And I don't mean that disrespectfully.
No,
we weren't getting calls, just to be clear. So,
yeah. No, I get it.
But so many times, like literally my neighbor, who's a dear friend, I talked to him a day, took a deal because he's a trades guy and good guy. And the phone rang one day and he was ticked off because he had a tough day at work and an employment issue. And it's like, oh my goodness, somebody's going to pay me 10 times for my business. Where do I turn that LOI, right? I mean, not knowing if his business was worth 20 times or 2 times. And by the way, what does that piece of paper mean? I'm not sure. It's just a bad day. Somebody's writing me a big check. Sayonara. I think the biggest thing is taking the first phone call or a one-off phone call. Again, to cut through the noise, the reason that buyers are calling is to get a proprietary deal. And the reason they want a proprietary deal is because they want to pay you less than they would have to in an honest process. It's just that simple. Otherwise, they wouldn't be paying people to make the calls. They'd only be calling bankers who represent companies. And so I think making sure that one, you've got one shot. If it's an M&A deal or even a capital deal, you've really got one shot at goal to get right. And when you send an LOI, all that really means is you can't talk to anybody else that's been calling. And now they're at control. And so slowing down to make sure that you find the right deal. And I think even more so, the soft stuff with the right partner that's going to take care of your legacy. And if you're going to be a partner with you is the diligence is both ways. And I still think in the lower middle market, Main Street America, it's pretty unsophisticated. And, a lot of people just take the guy that calls on the right day or the gal that calls on the right day. And it's critical to slow down and make sure it's the right deal. And people that write checks for $100 million for your company don't ever want to pay you one more dollar than they have to. And the only reason they're going to is because somebody else is going to.
100%. And, from some of the advice I've received from a lot in my career is you want to have, and I keep saying this because I think the teams, the advisors are so important, is that if you're going to start responding or you want to start responding to some of these, it's better to get a banker involved or to get someone involved and let them help you with those responses and let them help vet it out, because you want to make sure, to your point, you only get one shot at this sometimes. You want to put your best foot forward, right? And the way you put your best foot forward is having a solid team that's going to support you in that effort.
Oh man, you're preaching to the choir, but I believe this, and here's the proof. Private equity firms who literally who all used to be investment bankers. That's how you get into private equities. You start as an investment banker. In other words, they are the most trained people in the world at doing deals. So once they buy you, they might call you and say, "I want to buy you," and don't use a banker. They're saying that because they don't want to pay more. When they buy you and they sell you in 3 to 7 years, ask them this question: are you going to use a banker to sell our company when you own it? Real companies don't sell without representation. I actually do board work as well. I've never done a deal, even myself, without hiring another investment banker. So I'm not saying you need to hire Bridgepoint, but real companies don't sell without bankers. The practical matter beyond that is there are thousands of hours of work to do to get a deal right with the right partner. And the most critical time for an owner and a CEO and a CFO to run their business and perform is during the deal. And if you spend 2,500 hours of management time, you're going to have way worse problems than, my deal is hard. And so there's a reason that bankers exist. Not all of them are great, but using great ones, is a multiple of the return and is the only way to do it. I squarely believe that. I would not let, anybody I'm related to or my best friends sell their company without doing everything I could to get them to hire a banker.
Yeah, one mistake, takes care of that fee at the end of the day. And really, there was another gentleman I interviewed, I believe it was Pete Moore, if I recall correctly, but he uses sport analogies and sport playbooks as part of his philosophy. And I would look at the banker and the M&A attorney and the all the folks involved. That's your special teams. You bring your special teams in at the right time, right? And that they're so critical to winning the game, right? Just in football, that field goal could be the winning field goal. You brought your special team in, right? Same thing with deal making. Bring the special teams in. It'll make a big difference. And honestly, for operators, you don't have the time to run the deal effectively by yourself. That's just the reality of it. There's not enough time in the day to do that. Right? Unless you stop everything and then all of a sudden your business freezes and all of a sudden everybody's confused on what's going on and you're disconnected from the business again. Like that's what could happen. And unfortunately, when you're selling your business, they're not going to take that into account. Oh, okay, revenue dipped a little bit because you've been in this mode of, doing X fundraising or selling your business, right? So it pays in dividends for sure.
We often say it's like brain surgery, right? Would you hire, the nurse practitioner to do your brain surgeon? Probably not. It's kind of a special teams analogy. And I do think the other thing that I was going to mention previously too on mistakes is, the business owner gets a call and signs an LOI. The number of times I've heard, well, I've got an LOI and it says $100 million, so that's done. Basically, what can you do above that? The reality is you could write a cajillion dollars on that piece of paper and it would mean just as much, right? Getting to the finish line with that number or a number is a totally different,
completely different beast. That's just to get started on figuring out how do they chip away, right? That's just to say, hey, we're in the door. All right, you didn't register taxes here. We're going to chip you away there. You didn't do this. We're going to chip away here, right? So, no, I get it. Yeah, exactly. Now you're in the dance. So this has been great. So, tell me this: how did you, first and foremost, how did you get into this world? Why did you get into this world? And then why did you decide to take it a notch up and say, "Hey, I'm going to start my own firm"? It was yeah, right.
Well, Steve, we were talking about kids earlier, and just the phases of life and maturing as a person, and no bones about it. The reason I got into this 21 years ago is it was the one job out of college you could make $100,000 at. And I'm sure I had some great answer in my interview, but I was like, wait, somebody's going to pay me $100,000 to do something? Like, I don't know what it is, but point me at the brick wall. Which praise the Lord. I'm glad that happened. And it wasn't, I didn't have the plan, but somebody did. And fast forward to today, though, why we founded the business is totally different, right? I think as a man, at least me personally, like I want to get up in the morning and have purpose and really believe in the mission that I'm running at and that I'm helping people. Like that's kind of for me, and that we're having impact. And so we I spent the first 10 years of my career at two of the world's largest investment banks doing really large private equity transactions, KKR, Blackstone, Carlyle, like TBG, the original, 10 masters of the universe. And I got about 10 years into that, and I had lost passion for making big private equity firms more millions, but I always loved helping the Main Street American business owner who, started their business with an idea, college buddies, or a ladder and a truck, and taking risk and employed people in, flyover country. Like for me, that was really important work, and I love the relationships and the impact. And so my wife, Natasha, and I, who's our COO to this day, we met working at the second biggest bank in the world, and we moved back 15 years ago, 2 weeks ago, by the way, been in business for years, and really said, we've been a top investment bank, so let's use that level of excellence and use it for the underserved, which is, lower middle market, Main Street American business owners. And so founded our business 15 years ago with that vision, literally in our garage. And so we don't work for private equity firms, which is kind of crazy. There's probably 50 private equity calls here today, but they're our counterparties. There's a little bit of a Robin Hood angle. We love and are very mission driven, not just us now, but all the bankers who are like us that want that same mission, making sure that real people running real companies and employing people in places that matter do the best deal, are aware of the options, and are well represented. And for us, that is a very exciting mission. And for me, it's two things. It's that mission, and then it's the impact that we can have through that work. So it's been super fun. We had a big conference last week, and somebody said, "Man, it's amazing." I got up in front of the people and said, "Hey, thanks for being here. We're very humble." Somebody said, "It's amazing, 15 years." And I said, "Well, it is very amazing, given every day for the first 7 years, we almost went out of business." But it's been a blessing. It's been a blessing. And, Main Street American businesses are the heartbeat of our children's future. It's pretty easy to get excited about. And what we found is there are a bunch of big bankers who also love that mission and want to work for on the side of the table that they believe in.
Right. Now that your story resonates with me. We don't have time to go into my background, but you and I on a separate topic outside of the podcast, we can chat more about it, but it definitely resonates with me for sure. So this is great. So I guess tell us, how do people get a hold of you, right? If you can share your contact information, why should they get a hold of you? Tell us a little bit about that.
Yeah. Easy part first, contact information. Our website, my full contact is on there, bridgepointib.com. My email address is mplooster@bridgepointib.com. If you email me, I will email you back the same day. Still old school like that. More importantly, the why, I think back to the conversation, Steve, there are a lot more exciting options out there for capitalizing your business and your family and growing your business than there ever have been. And most people on Main Street America don't know what those options are yet. We're in the early days of the education and the efficiency of that. And so don't get me wrong, if you want to sell your company and it's worth $200 million, we'd love to get a phone call or an email. But what's really exciting to me is the solutions that are available and educating people on the art of the possible. And so we love that conversation around options and what are my options. And I've got this, I'm a normal person who's a founder. I maybe know what EBITDA is, but I don't know, I've got a set of wants and problems and needs. How does that translate? What are my options to capitalize those wants, problems, and needs? That's something. And then what are the pros and cons of the options?
With all that being said, I'm sure people are going to love this conversation. Thank you so much, obviously, for being part of the show. Every time I tell every guest this, there's so much we didn't unpack. Like, we're just barely scratching the surface. So I always like to invite my guest speakers back so we can dive a little deeper into the topic. So hopefully we'll have you back on the podcast in the near future.
Steve, it's been fun. It's been a blessing. Thank you, Brett.
Yeah, that's a wrap on another episode of This Is M&A. We'll see you on the next episode. Until then, stay sharp and stay deal ready.
If this episode sharpened your thinking, share it, post your take, follow the show, or drop a quick review and bring it into your next deal. We'll be back with more real talk from people who've been in the room when it counted. The views and opinions expressed on This Is M&A are those of the guests and hosts and do not necessarily reflect the views of any company or organization mentioned. This podcast is for informational purposes only and should not be considered legal, financial, or investment advice. Always consult a qualified professional before making business decisions.